Hi, I'm Michael Joyce with JoycePayne Partners, and I'm here today to share with you our market views for the summer of 2014. So as we came into the end of June, the U.S. gross domestic product, which is the measure of economic growth in the United States, was downgraded for the first quarter to show that economic growth had actually slowed to negative 2.9% for the first quarter of the year. Now, a lot of that was probably weather-related, but it was still a shocking number. If you add to that unrest in Ukraine, in Syria, and most recently in Iraq, there was a lot of negative news swirling around. So how have U.S. stocks done in that period? They're up. They're at record levels. What about bonds and global debt? Up. International investments? Up. Commodities? Up. Real estate? Up. In fact, every major asset class is up for the first half of the year. And that's really an unusual event. That rarely occurs. But it gets even better, because during this period where all the major asset classes were up, we had a decrease in risk and volatility. There's a measure called the VIX, which is sometimes called the fear index. And that index for the quarter that ended June 30th actually dropped from about 14 to about 11.5. Now keep in mind that back in the financial crisis, it actually reached a high of 90. So over the course of a couple of years, it's fallen from 90 to near record lows. So with the higher returns and lower level of risk, risk-adjusted returns have really gone through the roof, which is great for diversified portfolios. But here's where the curmudgeon in me starts to come out. And my sons would say that being a curmudgeon is my normal state, but that's really not true. But what I'm worried about is that investors are getting too complacent. I talked about this last month when I wrote a tweet about this that you can look at on JoycePayne Partners' Twitter account. But it is important not to get too complacent, because I think there was justifiable criticism of investors back in 2007 when the VIX got very low, that they didn't see the gathering storm clouds with the financial crisis coming up. Now, I'm not saying that there's going to be another financial crisis. In fact, I think there's a pretty low likelihood of that. But we do need to be aware that things happen. And there could be exogenous events that could happen that could impact the markets. And we want to be aware of these so that they don't negatively impact your long-term financial goals. So what about stocks? I mean, can stocks stay at record levels? Can they go higher? Will they have a correction? And they can go higher. You know, there has been slowly improving economic growth, slowly improving corporate earnings, so they could go higher. But we do think it's not going to be a straight line. There is going to be some correction in the market at some point. It's now been over 2 years since we've had a correction of 10% or more in the U.S. stock market. And as I talked about with the complacency before, investors are getting a little complacent that there has been so little volatility. Over the past couple decades, the average intra-year drawdown has been about 14%. And in some of those years, the markets have been up over 20%. So while we are cautiously optimistic about long-term stock market returns, we don't think it's going to be a straight line. So what about bonds? Bonds, the yields are still pretty low. Are interest rates going to go up? And yes, we do think that interest rates are going to go up, but it may not happen that quickly. Last year, in the second half of the year, we saw a pretty big increase in rates, and investors in more interest rate sensitive bonds saw some negative returns in the second half of the year. Now, so far this year, bonds have done pretty well. There's been what's been called a stealth treasury rally, where the benchmark 10-year treasury note has gone from a yield of about 3% down to about 2.6, 2.65%. Also, other bonds have also seen their credit spreads tighten a little bit. And what I mean by credit spreads tightening is the yield that they earn over treasury bonds, which are considered to be riskless. International investments have also done well. The emerging markets, which, as you may recall, had a pretty poor year last year and started the year poorly as well, have made a big comeback in the past 6 months. And I think that's pretty important, because at JoycePayne Partners, we're big believers in diversification. Last year, the U.S. stock market had the highest returns of any major asset class. But that's a pretty rare occurrence, and certainly almost never happens 2 years in a row. So you want to be invested in other asset classes, particularly ones that might do well if the US stock market doesn't do quite as well. So you can learn more about our other viewpoints by visiting our website at JoycePaynePartners.com. You can see our blogs there, and you can see how to access our Twitter account. And I look forward to talking to you next quarter.